KMV credit rating model. This post is a result of ongoing economic condition due to coronavirus outbreak. Taking you all through the very basic thing, that is, what is credit risk? A credit risk is the risk of default on a debt that may arise from a borrower failing to make required payment. Credit rating model. A credit rating is a quantified assessment of the credit worthiness of a borrower in general terms or with respect to a particular debt and navigation and status analysis done for this credit rating, and KMV is one of. Now, the Indian banking sector under the attack of the COVID-19 pandemic is set for a difficult time ahead. RBI expects the NPA in the banks to rise to 9.9% by September 2020. Now, more RBI, Reserve Bank of India is directing banks to make 10% provision on all moratorium loans. This shows that ba- they want banks to be prepared for the worst scenario ahead. So the prudent banks must calibrate their rating models properly for managing risk of commercial loans. In this direction, market-driven model like KMV may be useful. Now, what is KMV? KMV is a market-based model used to know about the borrower's solvency by calculating EDF. If is expected default frequency or is the probability that the firm future market value will be insufficient to meet its future debt obligation. Now, estimation of current market value of firm asset and of asset return by market stock return, volatility, and book value of liability. Actually, the value of default is the function of market value of asset, book value of liabilities, volatility in the asset, and risk-free rate and term debt debt maturity time. So this volatility in asset can be calculated by using volatility in equity. Volatility in equity is a function of volatility in asset. And in this way, KMV incorporates market condition in its calculation of the default value. When market value of asset moves towards book value of liabilities, chances of default increases. Now, what is distance to default? Actually, the crucial steps involved in calculation of this default value is calculation of distance to default. What is to default? Distance to default measures the difference between estimated market value of the asset and the total liability, scaled by standard deviation of the asset market value. Now, mapping expected default probability from DD using normal distribution. Now, we will calculate probability. So, to suppose distance to default is 1.64 approximately. Now, and MVA market value of asset is 18.955 million, and default point is 14 million. So, distance to default 1.64 implies firms to enter the default region, asset value would have to drop by 4.955 million, which corresponds to 1.64 standard deviation. I would like ask Anshul to proceed further.
Okay, thank you, Sneha. Uh, Good evening, all. I'll be discussing the next part of the post, that is the interpretation of the EDF. EDF is basically expected default probability. Default is basically the failure to make the principal or the interest payments. Am I audible?
Continue.
Huh. A firm defaults when the market value of the assets falls below its liabilities payable. That is a default point. So default point, as discussed by Sneha, is basically the threshold point below which, if the value of the assets or basically the market value of the assets falls, uh, the firm's chances of default increases, or the firm will default over its obligations. So composition of EDF, it includes three parts. First one is market value of asset, second one is default point, and the third one is vulnerability of market value to large changes, that is the asset volatility. So its interpretation, like the calculation of EDF, is consistent leading indicator of the banks or any agency rating upgrades and downgrades. So an increase in banks EDF measure indicates that there is a greater chance of default, or there is a greater default risk, even if the current absolute level might be excessive compared to a user's actual exposure. In this way, EDF metrics can provide early warning signals of risk or taking the risk assessment. Now we will be taking an example of Lehman Brothers. Lehman Brothers was the fourth largest investment bank at the time of its collapse. It became the largest victim of the subprime mortgage crisis. Uh, there was a housing boom which attracted the bank in the mortgage-backed securities at that time, and they started to give poor quality loans to the borrowers in order to attract or in order to increase the credit growth. So, like in the year 2006, housing prices began to fall rapidly at that time, and many subprime borrowers they began to default on their payments, and it revealed the very much risky nature of these debts. So in this way, the value of assets in the form of mortgage-based securities reduced, and it resulted in the failure of the bank, and the bank collapsed. So we can draw one lesson from Lehman Brothers default. Like there is a very much importance in focusing the movement of firms' EDFs. And Lehman's first year, 1 year EDF metric was just 0.1% 6 months before the firms defaulted, and it was like 0.6% 3 months prior to the event. So these figures are significantly very low in the absolute terms, but as we have seen, the impact is very large, and it represented a significant underperformance. So now EDF and its corresponding rating. BP stands for basis points. Like 2 to 4, 2 basis point means that 0.02%. So if the EDF level is between 2 to 4, the rating would be very high, and the chance of default is very less of a firm. So its rating would be AAA or AA. If the EDF levels are between 4 to 10, it's AA or A. If it's between 10 to 19, it's A or triple B plus. 19 to 40, it's triple B plus or triple B minus. In the last 143 to 202, that the rating would be B plus or B. So now would be coming across why KMV. What is the importance of KMV, and why Indian banks should approach this model? Like it is a holistic approach aimed for the real-time assessment of the financial health of the creditor. Like it considers the real-time value of the equity stocks or the market value of the assets. So after assessing the financial health of the firm, it takes into consideration. It has a wider application in measuring the solvency, and it has been observed that a combination of KMP model along with the sector-specific financial ratios can tend to give convincing results in Indian market as well, which makes it a go-to option for the financial institutions for credit risk modeling. Now, KMP model is used by various banks. India is not using as such, but HSBC, Standard Chartered, ANZ, I mean the Australian and New Zealand banking group, the Deutsche Bank, and the credit rating agency Moody's. Moody's KMV has provided many tools and services which provide current default probabilities, recovery estimates, valuations and correlations, and are widely used to assess the portfolio risk and returns. Moody's KMV it serves more than 2,000 clients in 80 countries. The company maintains the largest database of the corporate defaults in the world, and HSBC is basically using this model. It has taken on the Moody's KMV portfolio manager to help assess the bank's credit portfolio risk. The portfolio manager evaluates the portfolio credit risk, economic capital by measuring the portfolio and benchmark volatility, concentrations, and the tail risk. So we have drawn a conclusion uh, of the post. Like in one of the FSR, I mean the Financial Stability Report of RBI, it has been mentioned about KMV, about the modern method of credit rating, but as such, it has not been implemented in Indian banks. We still use the traditional credit rating model or the risk assessment process, having the potential to estimate the probability of default in better manner and greater sensitivity towards the market condition. Like it is very much sensitive towards the market value of the assets and the liabilities. So it takes into consideration that, and KMA model should be considered in assessing the financial stability. So this was all from my side. And I think Viplar is online. If he would like to say something about the post, his experience about working on this post. Hello, Viplar. Hello, Viplar. Can you hear me? Okay, Biplab is saying that he is not he don't have a microphone right now, so he is not able to speak. So I think this was the end from my side. Sunil, what's the next step?
If anybody has any questions or suggestions, so
Yeah,
we
I
can
think I
put.
have a question. Am I audible, Anshul?
Yeah,
So you mentioned the market value of assets and liabilities. So can you explain on which assets are we talking about? Or are these measured against the market value of the stocks of the company, or are there any real-time assets that are being tracked? Secondly, if we talk about Indian scenario, how can this be implemented for companies or SMEs which are not readily sharing the information to banks or are listed? So how can KMV be implemented in India? Thank you.
Sneha, would you like to answer this question? Hello, Sneha.
Yeah, hello. Am I audible? Hello.
Continues now.
Yeah. This KMV model is for listed company, so we will not be able to calculate the things for unlisted company. And what was the first question? Will you please repeat?
Yeah, I was asking about what are the assets that are considered for company, like market value of what assets exactly, apart
Stock
from the
price,
stock.
basically stock. Yeah, you can say like stock price, and there's one price and one stock price. When stock price is greater than that exercise price or face value, then your company is like in profit. And when this price falls below this strike price, your company is not solvent.
Basically, only the stock price is looked at. So
Yeah,
if we talk
yeah,
about
yeah,
unlisted companies or SMEs, so it cannot be implemented for them.
yeah, yeah.
Okay,
It's generally for the big giants.
thank you.
Hi everyone. I hope
Yeah,
am I audible?
yeah, yeah, yeah.
There's just one observation that I made. The biggest application of KMV model is in the field of mergers and acquisitions. So if you guys can include that in this course, it would be much better. Only if you find it feasible.
Okay, we'll try. Anyone else?
There is a question from Aditya. I'll just read it out.
Yeah,
Since the model considers
yeah, yeah,
volatility of
sure.
market prices, so don't you think it will change the EDF of company on continuous basis?
Yeah, that is the like speciality of this model. Actually, this is very sensitive to change. Then it will tell you about the decrease in the solvency of the company better. So this is the main specialty of this, like covering the minor movement in the market condition also.
If anybody is having any more points to add, in general also, anybody who's having good idea about the model, they can add if something was missed out. More than welcome.
Actually, we were supposed to make it as simple as we can. So in this way, we come out.
Like it's a more technical topic. There are many things to cover. So we have just put it as simple as that as we could. And
So I think there are no more questions. Thank you, Anshul, Sneha, and Biplab, for this amazing presentation. Uh, Thank you everyone for the time and patience. If anybody missed, we'll upload the video on our channel. You can catch it up there. Thank you. Good night.
Okay. Thanks a lot. Bye.
Okay, Anshul, there is one more question.
I think Shubham has a question.
Um, just a minute.
What about the companies which do not have debt?
Actually, am I audible?
अरे कुछ छूटा होगा, I'm sure.
Actually, this model is based on option pricing model. That means there's a put and call option, and this in put option, what happens that shareholder setters has the option uh, to take the whole assets when in case of any default, and shareholders put all the assets of the company to the debtors and fulfill their debt demands. So in this way, if in case there is no debt, then the whole thing is of equity shareholders thing.
Okay, guys. Thank you, everyone. Thank you, Anshul, Sneha, and Biplav once again. We'll wrap it up here. Thank you.